Boa tarde, good afternoon, everyone. I'm Daniel Guevara, Portfolio Manager here at WHG. I want to welcome to our Wealth High Governance Investment Book Club. This is a special edition. We are honored to host Michael Mauboussin, a legend in finance, one of the few that can be described as the favorite thinker of your favorite thinker for its deep and creative work in all aspects of finance. For those who are new to this book club, we are approaching the 60th edition. We are big believers that theory meets practice and generate alpha through these lessons. And I'll let my colleague here, Gustavo Campanha, portfolio manager here at WG, and a former Mauboussin student, to properly introduce you.
Thanks, Daniel. So it's an enormous pleasure to host Michael Mauboussin. He's the head of Consilient research at Counterpoint Global, that is an active fundamental equity team inside Morgan Stanley Investment Management. And he publishes frequently about everything related to finance and decision-making, portfolio construction, securities analysis. So it's a really interesting read that we all recommend you to subscribe to. You can go to Morgan Stanley's website and find it. We'll leave links in the description for that. And it's also the 30th year that Professor Mauboussin is a professor at Columbia Business School. It's like 3 decades teaching the course that once was taught by Ben Graham, that is the security analysis course, that I had the pleasure to learning from him back when I was there. And it's always provoking and enlightening to read Professor Mauboussin's books, papers, since his times at Legg Mason, where he was a chief investment strategist, and head of global financial strategies at Credit Suisse First Boston, director of research at Blue Mountain, and now at Morgan Stanley Investment Management. And one interesting thing, Professor Mauboussin has been a board member at Santa Fe Institute. There is a very interesting think tank that merges scientists from multiple fields to collaborate. Really interesting and important work he done there as a chair and as a board member. And also Professor Mauboussin's pieces span across like decision-making, security analysis, skill and luck, mental models, and his papers are part of every PM analyst education. And today we will discuss a little bit more about expectations investing. That is one of the books we'll give more focus, but we have links in the description in this video for all his books. So without further ado, welcome.
Thank you, Gustavo, and thank you, Daniel, for such a warm and generous introduction. I really appreciate it. It's a real pleasure and honor to be with you guys today.
Thank you so much, Professor. And the idea here is like it's focused on many learnings from you, like kind of a best off of all those years of many great things you wrote about. And focusing first on the expectations investing, you co-wrote this book with Al Rappaport, and the idea came from a chapter that was using what managers could use for their the evaluation of their companies, what was embedded into what stock prices could tell them about this. So I would say with the given market movements, we couldn't have a better time to apply many of these concepts, right? And our clients in the audience today are in great part business owners. They are also investors themselves. Many are financial market professionals as well, listening to our content here. And I would say, like, if you could like give a brief explanation of what is the expectations investing framework, how we can apply them in our day-to-day investing, and also in company management, that'll be great.
Thank you, Gustavo. It's a great way to kick off. I'll mention my co-author, Al Rappaport, on Saturday, so May 7th, celebrated his 90th birthday.
Wow.
And he's just fabulous, and I talk to him multiple times a week. He's still going great. We're working on a bunch of projects. We have a paper coming out later this year. So it's just, for me, an incredible opportunity to work with a phenomenal mentor and teacher and a friend. So all the best to him. He wrote a book, and so going backwards, Al Rappaport was an academic. He taught at Kellogg School of Management. And his PhD is actually in accounting, but he taught a lot of finance, and he did consulting on the side. And most of the consulting he did, not surprisingly, was corporate companies. And as a consequence, he spent not that much time with investors. Creating Shareholder Value was his book that came out in 1986, which really the target audience for that was managers of businesses. And there were three lessons I learned, and Gustavo, you know this because we talk a lot about this in class, but the three things that he talked about in that book that really resonated with me and became the bedrock for everything I do is, number one, it's not about accounting earnings, but about cash. And I know many of the people in the audience who run businesses or appreciate businesses know that very much to be true, right? At the end of the day, it's how much cash goes in versus how much cash that goes out from here to kingdom come that determines the value of the business. The second thing he talked about was the link between competitive strategy and valuation. And in business school, we almost do a little bit of a disservice to our students, right? So we teach all about, how to get a moat, so competitive advantage and 5 forces and value chains and all this good stuff. And it is good stuff. And then we talk about finance and valuation, almost like it's a distinct thing. But, what you realize is that valuation and strategy have to be joined at the hip. In other words, the definition of a good strategy is that it creates value. And to really understand the valuation of a business intelligently, you have to understand its prospects, its industry positioning within an overall sector. So that was another lesson I took away. And then the third one was a long-winded answer to your really good question, but chapter 7 of the original book was called Stock Market Signals to Managers. And the argument was, if you're an executive allocating capital, right, whether it's CapEx or M&A or buybacks or dividends or whatever it is, it's really incumbent on you to understand what's priced into your stock, right? So what financial performance do you need to achieve to satisfy, or better yet, to exceed the expectations baked in by the stock market? And so while that was aimed at executives, the relevance for investors was obvious, right, and immediate. So I started using those tools wearing an investor's hat, which allowed me to meet Rappaport in 1991. So 31 years ago, right around this time, actually 31 years ago. And then from there, we started to collaborate lightly. And then toward the end of the 1990s, decided to write the first version of Expectation, again, using the same concepts, the same tools, but applying them specifically for the world of investing. So it's really the opposite side of the same coin, right? Which is, Daniel talked a lot about finance and so forth. It's really finance that applies both for executives as well as investors, using the same tools to make hopefully good decisions over time.
Indeed. And this is one thing where we try to gauge here. And it's whenever you see a stock, especially for sum of the parts calculations, people are used to using this kind of a framework in terms of what is priced for this specific thing. And what's really beautiful about the framework in expectations investing is how you can really see what has to happen for the stock to work. And this is one thing that is a really important takeaway. And one thing about the republishing of the book, recently you had a re-edition of the book. 20 years ago was the first edition.
Mm-hmm.
What changed since then? What led you to decide it was time to republish it?
Yeah, well, it's a good question, Gustavo. And first, I'll just say, of course, that we signed the contract to write the book in the late 1990s. And as you know, the stock market was roaring and everybody was very interested in it. It was a little bit like 2021 earlier in the year, right? And then by the time the book came out, it actually came out September 10th, 2001, which of course, the United States was a day before a substantial national tragedy and in the midst of a 3-year bear market. So it seemed like a good idea when we signed the contract, but when it actually came out, it was a very difficult and challenging environment. So obviously, as you know, I've been teaching from this book for many years, and things have changed about that. And so when COVID hit, we're doing more work from home, and I just spoke with Alan. I said, this might be another opportunity for us to circle back. So what is different, versus the original 20 years ago? By the way, there's sort of a fun little fact. I mean, one thing I did is I just examined the top 10 companies by market capitalization in the United States, and only one company is on the list from the 20 years later from the original time. And by the way, 4 of the companies didn't even exist 20 years prior. So it's kind of fascinating that itself, just to see how over the passing of time, how things change and which companies rise to the top. But 2 or 3 things I think are really big. The first is obviously the rise of passive investing. So you could say ETFs and index funds, which were always on the scene. They've been on the scene since the 1970s and really had made headway in through the 1990s, but really took off, I think, really prominently after the financial crisis, call it the last 15 15 or so years. So that's one big thing. And what does that mean for how we think about values and so forth? The second is something we've been spending a lot of time on in the last 24 months is the rise of intangibles, right? So investments have always been both in the form of tangible investments. So think about physical assets, factories and mines and machines and so forth. And intangible, which are by definition non-physical. So think software code or branding or training of your employees or what have you. And again, always have both been in the mix. But what's happened in the last really generation or two is that we've shifted from more tangible to intangible. And in the United States specifically, tangible investment was double that of intangible in the 1970s. And that relationship has flipped today. So what's interesting about that, Gustavo, going back to your mention about, sort of some of the parts and how we think about multiples is from a more technical point of view, more investment is showing up not on the balance sheet, like a traditional property, plant and equipment or working capital, but rather on the income statement and predominantly SG&A. And as a consequence, earnings don't mean exactly what they used to mean, right? And so companies that are in quotes capital light are almost always those that are investing very heavily on their income statement. So they are still investing, but they're just doing it in a different way, shape, or form. And so if you're following the cash flow trail, as we've advocated for the whole time, this is not a big issue. But if you're focused simplistically on earnings, then you can really miss the boat on that. So that's a good example of why these techniques, and again, cash flow model has been around for a long time, so there's no reinventing the wheel here, but why these techniques, I think, especially in this day and age, can help us give us some insight as to what's going on. There are other little things like, some we've learned more about how strategy works. The disruptive innovation framework, I think, has taken on more, people focus more on that. We did more of that kind of work. But yeah, those would be some of the big things. And, it's interesting too, that it gives you time to think about what is different and what is the same. And actually many of the bedrock concepts don't change. And by the way, the most bedrock, you mentioned Ben Graham, who we've all learned from, and we are all his intellectual progeny. But Ben Graham, always focus on the fact that we're buying businesses, right? We are buying partial stakes in businesses. Those kinds of lessons don't change. The value of a financial asset's the present value of the cash flow. Bond investors know that, and they never lost sight of that. All of a sudden, stock investors have to relearn that lesson. So some things do change, some things don't change, and the key that's really important in your investment process. What should be mutable, and what cases should you learn? By the way, I really applaud the book club. I just think this is the kind of thing that's very important for you and for your partners. And this notion of constant learning is recognizing that this is one of the fascinating and frustrating things about this game is we never have it beat, right? We always have something to learn. There's always some other stone to turn over. There's always someone that knows something you don't know. And it makes it fascinating, especially if you're intellectually curious, but it also makes it challenging, right? So I applaud that you're doing this as part and parcel of what you're doing organizationally, because I think it's really important.
Thank you. Let me make a link. There's a paper that you wrote, I think 7-8 years ago, called "What Does Price Earnings Mean?" I used to manage the research for another institution. This was the first paper I'll give to a new analyst coming to that. I think one sentence that you mentioned is cash is a fact, profit is an opinion. And when you look in the market, like price earnings is the primary method everybody like. There's a shortcut that everybody evaluate a business. Can you elaborate a little bit the right way of using multiples, because sometimes they are like misleading?
Yeah, no, exactly. Thank you, Daniel. And you're exactly right. I mean, what's good about multiples are shorthands, right? As I would say, the multiples are not valuation. They're shorthands for the valuation process. We use shorthands all the time in our life. There's no problem with that, right? In other words, I have no problem with shorthands. The problem is the issue can be is that shorthands themselves save you time, but can lead to biases or blind spots. So you really shouldn't be using a shorthand unless you understand those biases or blind spots. And that's really what we try to emphasize. And you're right. We wrote that piece, what does a PE multiple mean? We also wrote one called what does an EV to EBITDA multiple mean? And those are the two most popular multiples that are used in the investment community. So specifically taking a step back, what we want to do is link a particular price earnings multiple with a set of economic characteristics. And of course, the two really big ones are growth and return on incremental invested capital, right? So you can imagine two companies with the same growth rate. Let's just pick a number like 10%, but you can imagine that one is very efficient, needs to invest very little capital to achieve that growth, and the other one's very inefficient and needs to invest huge amounts of capital. Well, if we're counting cash flow at the end of the day, it stands to reason that the first business would be vastly more valuable than the second one, even though the growth rates are the same. So a PE multiple, and by the way, a lot of that is implicit in PE multiples, but what we want to do is separate the pieces and understand that very explicitly. So one of my favorite matrices that we show in the class is on the rows are different growth rates, across the columns are different returns on invested capital. And then we populate the rows and the columns with the price earnings multiples that fall out of that analysis. And when you do that analysis, you find three things that are really important. Number one is if you're earning exactly your cost of capital on investments, growth makes no difference at all, right? You can grow 10%, 20%, 5%, 0%. Your multiple doesn't change. Why? Because you're effectively on an economic treadmill. You can run as fast as you want, but you don't go anywhere because essentially you're just earning your keep. Observation number two is if you're earning above the cost of capital, growth is fabulous, right? And the faster you grow, the more wealth you will create. And that's a very important heuristic for example, high return on capital businesses. They are going to be super sensitive to growth rates. And you can just slightly moderate their growth rate and you'll see the stock multiple come down very dramatically. And that's a very, even building a simple model and trying to train your intuition can be very helpful. And then the third observation is that if you're not earning your cost of capital, growth is bad, right? And the faster you grow, the more wealth you're actually going to destroy. Warren Buffett's got a great line where he says, when you find yourself in a hole, the first thing you do is stop digging, right? That's a good example of that. And you might say, well, gee, how does that happen in the real world? Well, one example where it's very prominent is mergers and acquisitions, right? How many times have you seen a deal announced that is purported to be accretive to earnings, so it adds to earnings or earnings growth, but the stock price proceeds to go down, right? There's an example where there was a large investment, the market deemed to be net present value negative, even though from a pure accounting point of view, earnings went up, right? So there are a lot of important lessons that come out of that. And by the way, again, the math is slightly more complicated, but you do the same analysis for EV to EBITDA multiples. I don't want to leave anybody with the idea that multiples should not be used at all. They should be used. But as I like to say in class, we need to earn the right to use the multiple. And earning the right means that you can demonstrate you understand the underlying drivers. Now, the last thing I'll say is, Gustavo and Daniel, if I'm sitting down and we're talking about a stock or potential investment, it could be anything, by the way. It could be anything in a business. It could be, should we build this new distribution center, whatever it is. We really should be talking and debating specifically about the value drivers. We should be saying, well, how much growth can we get from this? How much investment is it going to require? What are the incremental profits going to be, right? And we should have those issues on the table. And that's what we need to debate. We're not going to debate and say, oh, here we're spending X. Should it be at 22 times earnings or 15 times earnings? That would be ridiculous, right? So we want to get down to what matters, what drives the value. And that is the point where we can really have, I think, healthy, thoughtful, grounded debates and make, at the end of the day, smart decisions about our capital allocation.
Indeed. And one thing that I think ties very well into that is the concept of moats and competitive advantages. That is like basically what can make you have investments that will derive growth that has a sustainable margin that will really make it worth growing. So like it's measuring the model says the second most important first papers of Mauboussin to read once you start. Like we have a new analyst coming in, he's already got your package. So he has a folder like read these things. And so if you could discuss with us a little bit more about how to measure moat, the competitive advantage duration, and maybe as a follow-up, automatically embedded on it, like how do you see the vast technological changes affecting the duration of moats over time?
Yeah, I mean, such a great question, Gustavo. And I'll just say that tying back to valuation one moment is, and you recall this from class, one of the things we talk a lot about this notion of, we call it competitive advantage period. So it's a period of an ability to generate excess returns. And it turns out, of course, for companies, generating excess returns on new investments can be challenging for two reasons, right? One is competition. So if you're investing in, let's say you're a retailer and you're building new stores and they're fabulous and very profitable, people are going to pay attention to that, right? They're going to notice that, and your competitor's going to come along and say, gee, I'm going to build a store across the street. I might have slightly lower prices or whatever it is. And so they're going to try to compete they're going to try to wrest those profits away from you, right? So that's just basic competition. And the second thing is, of course, if you're also very successful, you'll saturate your market, right? So at some point there's maturation of the market and just there's less incremental growth achievable, essentially because you've done your job, you've gone out there and done the thing. So competitive advantage period is a very important concept. And it's quite intuitive that it's different for different types of businesses, right? And we know that for a fact, just, again, things like energy are going to have by and large shorter competitive advantage because they're dealing with commodities and things like, for example, consumer staples, where these are the products you buy in your house and your bathroom and so forth over time. Okay, so that's the first thing. So how do you think about this competitive advantage period, or as you use the term moat? The term moat has been popularized. That was first, I think, talked about or made sense from Warren Buffett, where he says you really want to buy a business that's like a castle, right, that has a moat around it, and the moat is protecting the economics of the castle from potential attackers. So I'll just say this is a little inside story because I originally wrote the piece Measuring the Moat probably 20 years ago, but that was one of the most difficult research reports I ever wrote. It took me a very, very long time, did a lot of reading. It was very laborious. So I hope when you and your new analysts read it, that it's not too hard for them to sort of go through the logic of it, but putting it together is, it's just a substantial amount of synthesis. But there are really three parts to it that I think are important. The first section we call lay of the land. And here you just want to sort of acclimate to what's going on. So this would be, for example, building an industry map so you really can lay out on a piece of paper and see who the competitors are, what the dynamics are. And I always like to say anything that could affect the profitability of your company should somehow or somewhere be on your map. Things like market share tests. So are market shares stable? Or are they moving around a lot? If they're stable, that's more consistent with competitive advantage, sustainable competitive advantage. If they're moving around a lot, that's not good. So that's also related to entry and exit data, which is also important. The pricing tests, or prices going up or down, right? Again, these are all indications of essentially the stability of the backdrop in which the company is competing. Then the next section is on the industry itself. And here, I think you can go back to classic Porter work, right? Michael Porter's 5 forces, thinking about the 5 forces that affect the economics of the businesses. I like to say, unfortunately, even our business school students still do this. They do what I call the Wikipedia 5 forces. So they go to Wikipedia, but if you actually read Porter and you do it really thoughtfully, you can gain a lot of insights, or at a very minimum, raise a lot of important questions for you to think about, for you to debate, and for you perhaps to discuss with the management team of the company. By the way, I read all the original Michael Porter books right when I got out of undergraduate, but I'll say that there's a wonderful book that came out about a decade ago called Understanding Michael Porter by a woman named Joan Magretta. Magretta worked with Porter. She was his editor and worked elbow to elbow with him at his Institute for Competitiveness. So the Magretta book is a fabulous entry into the Michael Porter work if you're not familiar with that. And then, I had also things like the Clay Christensen work on disruptive innovation is fabulous. And then the third and final block is the actual company's competitive advantage. And, using Porter language, and this maps over to Bruce Greenwald at Columbia Business School language as well. There are basically 2 ways to get there, right? One is being a low-cost producer, which typically means you have low margins and high capital velocity. And the second way is differentiation, which generally means high margins and okay capital velocity. And by the way, just knowing the margin structure and the capital velocity itself will sort of point finger into where you should be spending your time and attention. And here the tools include things like value chains, so really understanding where the company adds value, stacking it up versus its competitors. And then the piece we finished with some other stuff in there, including game theory and work on co-opetition. So game theory is, is a recognition that actions are not unilateral. When you do something as a company, there's going to be a reaction of your competitors. So action and reaction. So game theory is one of the ways to think through, if I raise my prices, what is my competitor going to do? If I add capacity, what is my competitor do? And again, trying to understand that action reaction. And co-opetition is, again, getting yourself into ecosystems rather than just thinking about one, a sort of a zero-sum games, right? So you can you as an organization be part of or build an ecosystem where there's value creation writ large rather than just I'm extracting value from somebody else. So that's a long-winded answer to a really a big question, good question. And the end of the piece has a checklist. And I'm hopeful your new analysts are doing this, because when you go through it the first time, it actually takes a long time because there's a lot of work and it's laborious and so forth. But when you go through it a few times, you get faster and more efficient at doing it. And the checklist is a great way to do that. So you guys are the more seasoned, fund managers, but the younger analysts, they might say, I didn't do that analysis because I didn't think it was important, right? For you, as a more seasoned investor, you might say, gee, that is important. So I just think it guides people's work in a structured and effective way. And hopefully, again, there are probably no answers per se, but it poses a lot of the most important questions that you need to think about and debate about.
On that matter, like 2 quick follow-ups. One is, do you see the duration of moats like being challenged? So this competitive advantage period like being shrunk under the time. And the second one, is there any sectors of pockets? Because I think the market in the last 5 years thought that the software as a service the best business in the world. But I think there is another like pockets of competitive advantage. Anything on that?
Yeah, I mean, Daniel, it's a fascinating question, and the very fact that I just suggested that the top market cap companies today are different than 20 years ago suggests that it's very difficult to stay at the top of the mountain, right? So that's the first thing just to acknowledge. And there are obviously today in the world some fabulous businesses, and that it's reasonable to expect that they'll be at the top of the mountain for some time. To answer your question more specifically, there's really interesting work, and I think that we need to get some updates to this, but it's Wiggins and Roofley. So I can't remember the first Wiggins, and I'll send this to you, but it's Wiggins and Roofley, 2 academics that studied specifically this notion of sustainable competitive advantage. And they came to the conclusion that over time it's been shrinking, right? And in large part, that's because mostly by the way, it is because of technology, but it's not limited to technology. So it's a broader concept in general. So now the flip side of that might be, it's almost like the shooting star phenomenon, right? So I think what's happened is for certain companies and industries, we saw them generate very high returns on capital, but for very relatively short periods of time. So there was a lot of value creation, but it was mostly because the return on capital was very high, and then their day in the spotlight was short. Whereas other businesses are going to be much more methodical, the Coca-Colas of the world and so forth. Not very glamorous, but they can do this for a long time, and they're extremely entrenched. So yeah. Now, the one thing is interesting that is always been around, but probably more prominent today than it was, again, 30 or 50 years ago, is the notion of network effects, right? So network effect exists when the value of a good or service increases as more people use that good or service. So there have been battles for certain network effect, sort of leaderships and networks. And so we've seen those battles, and they're bloody, but usually the one that wins that ends up being in the pole position for some period of time. For SaaS businesses, for instance, a lot of the issues there become switching costs, right? If they really do get embedded in an organization and they're task critical, or even if it's a habit of some sort that you buy on Mercado Libre or you buy on Amazon or whatever it is, and you're just used to clicking the buttons and it's got all your information and so on and so forth. You can see how it reduces friction. You can see how those switching costs would be material. Little switching costs for lots of different people adds up to something meaningful. So yeah, and that's the thing. So this goes back to the expectations investing approach. And again, it's also important for executives to think about in their own businesses is, how much competitive advantage am I paying for, right? And so it's a combination of how are the economics, how are the cash flows in the foreseeable future. And just to be a little bit of a nerd for a second, in discounted cash flow models, we usually have 2 components. One is the explicit forecast period. We do scenarios, but of course we're really trying to explicitly forecast what we think sales and margins and profits and so forth will be. And then the second is a continuing value. So we're not going to model out for 50 years. We're going to typically assign a value for years X through whatever. And it is in that continuing value that a lot of the mischief happens, right? And so understanding competitive advantage and this notion of competitive advantage allows you to be more thoughtful about how you allocate the value and try to keep you from avoiding too much mischief in your continuing value.
I think that concept about the competitive advantage duration and also what to use for growth ties very well to the concept of base rates. That I would say is one of the main important takeaways that I would say I've had in my life in investing. Like, it's really, even tying it a little bit, like it helps you kind of gauge how much your intuition is telling you versus what on average this should be. It's a kind of like a coach for your intuition when you're thinking about something or even when you model something you want to cross-check. So if you could discuss a little bit with us, like what are base rates? How did you get to the data in your base rates book? And can you give us a kind of a view of how to integrate them on one's either investment process or even managing companies? Because base rates are basically they worth for many users on that.
Yeah, well, thank you, Gustavo. You mentioned, I don't know how do I feel about it, but you mentioned 30th year of teaching the course, and I guess it makes me feel old. But one of the questions that naturally arises is what's different about the course. You mentioned what's different about the book, but what's different about the course? And I came to understand or learn about base rates much too late in my life. I mean, if you asked me to go back and meet my 20-year-old self and just say one mental models, it would probably be the base rate idea. So let me take one step back. And I learned about this predominantly from Danny Kahneman, the eminent psychologist who won the Nobel Prize in economics in 2002. And he distinguishes between the inside and the outside view. I'm changing language a little bit, but I'll make sure everybody's on the same page. So the inside view says, if I pose a problem to you, and it can be almost any kind of problem, how will this company perform? How long will it take me to remodel my kitchen, and what will it cost? When will I, if I'm a university student, when will I be done with my term paper or whatever it is? The classic way to think about most problems and see if this makes sense in your own experience is you gather a bunch of information, right? You combine it with your own experience and your own, outlook, and you project into the future, right? And left to our own devices, that's how we typically do things. And, you ask an analyst, how did they build their model of the company? They're going to describe something exactly like that, right? I studied, I talked to the management, I read, look at this out, right? I built the model. The outside view, which is the same term as base rate. So outside view, base rates, consider those to be interchangeable. The outside view is going to say, I'm going to think about this problem as an instance of a larger reference class or the base rate. I'm going to ask, what happened when other people or companies were in this situation before? So rather than me thinking about my situation as unique, I'm going to think about it as an instance of a broader distribution, right? Or base rate. It's a very unnatural way to think, right? For two reasons. One is you have to leave aside all this work you've done, all this cherished information, and you have to leave aside or discount your own experience, right? We've all gone through the world. We've had good experiences and bad experiences, and we think that those experiences are really valuable in guiding our future decisions. They're not as invaluable as you probably think, right? And the second thing is you have to find and appeal to the base rate, to your point, right? And we'll talk about the base rate book in just a second, but I'd always been very frustrated that I knew this was an important concept, but I just didn't know the numbers, like literally didn't know the numbers, right? So what a base rate is a reference class that you can appeal to figure out, okay, so let's just make this very, very concrete. In the fall of 2020, and this is not a commentary on the company at all, but in the fall of 2020, there was an analyst report on Peloton Interactive, right? So this is the connected fitness company. We're in the middle of COVID, people are shut down. They still want to work out. And this is a very cool solution to do that, right? So they had come off a couple of really good quarters. They couldn't keep up with demand. And this analyst, using the inside view, I would say, penciled out, he believed that they could grow revenues 30% compounded annually for the next decade, right? And they had just done about $1.5 billion in revenues. Okay, so how did he come up with 30% growth? And the answer is he built a model, and you can see the model. By the way, it's very persuasive and detailed, and gee, they might even do better than that, the whole thing, right? But then the question, so that's the inside view. The outside view, or the base rate, would ask a very simple question, which is how many companies of that size have ever grown 30% compounded annually for 10 years? And the answer is less than 2%, right? And so all of a sudden that should call into question as to how plausible that growth rate is. It certainly shouldn't be your base case. Maybe it's your bull case, but it certainly shouldn't be your base case. And all of a sudden you have to rein in a lot of those expectations right away. So leveraging experience can be really valuable. Now, we won't go into this in any great detail, but there are actually some specific techniques to figure out how to weight the inside and the outside view. So your own views versus the base rates. There are ways to weight them because it's not all one or the other. Typically, it's some combination, but we'll leave that aside unless somebody wants to go in that in more detail. So knowing that this was really important, I sort of said to myself, we need to systematically set out to try to calculate these base rates, to learn them, right? So we did a lot of this work at Credit Suisse. They have a division called Holt, which has really cleaned up data that go back to 1950. So we're able to get really good, robust, gargantuan sample sizes. We did everything inflation adjusted, so inflation was not going to distort the numbers. And we did this for a bunch of different items. We did it for sales and sales growth rate, which is typically the most important value driver. We did it for gross profitability, which is gross income divided by assets. We did it for gross margins, operating margins, earnings, and then return on invested capital, right? So we did this for a bunch of income statement and balance sheet type of items. And we built this very large database to be able to observe these things. And again, like you said, Gustavo, you nailed it. I mean, sometimes you have your own sense of what's going on, and then you check the base rate and you're like, gee, that doesn't seem, it seems a little bit optimistic or pessimistic. And by the way, it works both ways. Sometimes if you're very pessimistic, you realize the base rate will pull you a little bit higher. The last thing I'll mention, I touched a few moments ago on this intangibles versus tangibles. And there's a really rich discussion broadly there. But one of the things that's happened in the last, say, 25 or 30 years is I think the intangibles have shifted the nature of those base rate distributions to some degree, right? So the first thing to realize that base rates, these are past occurrences. This is not tablets being held, chiseled in stone, handed down from the mountain, right? So they're living and breathing and dynamic distributions. And what we've seen is that intangible intensive industries tend to have, on average, higher growth rates. So that's kind of a good news. They also have more rapid growth. So the standard deviation is higher. So companies that grow much more rapidly, which is kind of the good news, but also companies that die much, become obsolete much faster. So that's sort of the bad news. So the distributions are much wider. So the mean is shifted a little bit positive, but the standard deviation is bigger. And that's a really important and interesting observation as we move forward. So again, the base rates aren't the gospel. They're not the end all be all, but an incredibly useful and I think broadly underutilized tool basically for thinking about corporate performance. So, so when you tie that into the expectations approach, you tie that into what the market is expecting and how reasonable it is. It's very powerful. It's a very powerful combination to think about these things intelligently.
No, that's interesting. Like follow-up question on that. Like if you take like fintech e-commerce, they have like elevated growth rates. If you were using like I would say the base rates in your investment decisions, probably you wouldn't get that excited on those industries in the last like 2-3 years. So you would miss the rally, let's say in this way. But at the same time, you'll be avoiding the fall right now as we speak. How do you approach that in that sense? And there's one company, for instance, like you take Amazon, like AWS, that niche, that subsegment of Amazon has been kind of challenging the base rates. The exceptions to the rule, that kind of investment, how do you approach that?
Yeah. I mean, Daniel, it's a great question. And by the way, I mean, it's anything can happen, right? So in other words, anything can happen, right? But you're just trying to think about what is the probability of it. Now you mentioned AWS, and that's a really good example. And there are other examples that are similarly interesting. The chapter 8 of Expectations Investing is called Beyond Discounted Cash Flow. And the argument is that for the vast majority of companies doing a standard expectations DCF. So by the way, just to explain the expectations investing process, and even executives will understand what I'm doing here quite readily, is we start with the only thing we know, which is the stock price, right? And so I know that stock price may be volatile, but we know what it is today for sure, right? We could buy or sell at that price. And then we reflect back using value drivers, sales, margins, capital intensity, and so forth. We reflect back on what has to happen for that stock price to make sense, right? So we're essentially solving for today's price. And so we're saying that's where the expectations are set. Doing that step, by the way, you'd like to suspend your own views of the world, right? So just try to do that, be agnostic and say, here's what has to happen. Then step 2, you introduce your strategic and financial analysis to say, okay, based on what I know and what I've studied and what my outlook look like, they're going to do better than that, or they're going to do worse than that, or gee, that I have no opinion that's better than the market, and so I'll move on to the next thing, right? So that's the basic premise of the whole approach. And what we argue in chapter 8 is, for certain types of businesses, that process may be lacking. And the reason is that there could be an embedded real option, right? So that's a fancy term, but a financial option an option in general is the right but not the obligation to do something, right? The right but not the obligation to do something. So there are financial options. So on a particular stock, you can buy it at a certain price within a certain time, okay, so forth. A real option is just the analog for businesses. So it's the right but not the obligation to invest in the business. The example that's most concrete to explain real options in a business setting would be something like an extraction industry, like a mine or a well for an oil company, right? So I'll just make this up. Let's say oil is $80 a barrel. Let's say oil is $40 a barrel, and the cost to extract it is $60 a barrel, right? So the current price, it's NPV negative. We would not extract it because the cost of extraction is higher than the commodity price, but the commodity price is volatile, right? So we know that project is not worth investing in now, but it's got value, right? Because if the price goes above the cost to extract, then it's in the money essentially, and then we want to open up that well and start pumping, right? And so there's value to that. So this is a technique to value those potential options. So what we argue in the book, in the original version of the book, we actually used Amazon specifically as an example. By the way, AWS was not even a sparkle in Jeff Bezos' eye, right, at that time. We used it. And we sort of said, okay, there are a couple things that are important. Okay, number one, it has to be an industry with volatility, right? Because if it's a boring industry, there's not a lot of volatility, there's not a lot of option value, right? Second, it tends to be a market leader. So usually the market leaders have the most opportunities to do things. Third is it should have a very astute management team, right? Management teams who are attuned to cultivating and ultimately exercising options. And then the fourth thing is you need to have capital, right? Because if you have an opportunity come along, you have to be able to have the money to invest, right? My oil well may have gone from out of the money to in the money, but unless I have money to start it up again, that doesn't make any difference. Amazon happened to have all those things. And, coming out of the .com sort of bust, they ended up generating enough cash to be able to support and ultimately very much grow rapidly the AWS business. And that's a perfect example. But the reason we used Amazon is they started off as a bookstore, right? It was when they went public, they were a bookstore and everyone was like, they're going to get crushed by all the other bookstores. And then they went into music, then they went to DVDs, right? And then they just expanded their offerings. And you could think of each of those as options, right? That they were out of the money options that became in the money as they grew their business and infrastructure, and hence raised a lot of value. So it's really, when you're just a bookstore, it's very hard to think about, what's a DCF for all these other things, because it doesn't exist. But the options are something that allow you to think about, am I willing to pay for something that's coming down the road? Now, in the new version of the book, our example is Shopify. And Shopify is also a very interesting business. And I think also has a lot of the same characteristics. So we'll see if they can or can't do things. They just bought a business the other day and they continue to do stuff, but we'll see how that one plays out. So you're making a really important, astute observation, right? That sometimes things come along and you need to have a bit of imagination, but I want to put a framework around that imagination, and that framework is real options. And again, there's certain things that have to be in place for you to take that seriously. And as investors, and I'm sure you guys are on the same page, as investors, you'd love to get those options as cheaply as possible, right? So you want them to be there, you want them to be potentially valuable, but you don't want to pay a lot for them, right?
That's an interesting segue to another question about Amazon, because if you look at how the market perceives it currently, everyone says, hey, you're buying AWS and getting all the retail for free. This is a common, very widely used quote we hear from the sell side and even from other buy sides. So, and to your point, tying up what you just said, like a business that has a lot of volatility, like the margin for retail, because it's like very close to zero, the law of large numbers, it's a really big revenue in retail, so profits can be very low or very high. And in that framework, retail would have to have a substantial value in this, and it for sure has. But the point is, how would you recommend an analyst investor to break down via expectations investing framework the value for such two divisions that are so different and with such high volatility.
Yeah. I mean, Gustavo, it's a great question. And I would just say that, and by the way, this is not investment recommendations on any stuff, but we're analytical frameworks and so forth, right? So that's, we'll make sure that that's out there. The first, I'll make one broader comment, which was that, and I don't know enough about the Brazilian companies and so forth, but I suspect that many of the managers of businesses this will ring true to them. COVID made it very difficult to manage businesses, right? It made it very difficult to manage portfolios, but very difficult to manage businesses, right? And at the end of the day, now that the dust is starting to settle, we saw that some companies did things that, in retrospect, may not have been beneficial, and other companies did things that may have been ultimately beneficial. And retail is a particularly interesting example, right? So when you shut down the economy and people are staying at home, things like delivery services become more valuable, and retail stores become, they are empty essentially. So what happens simultaneously? One is companies like Amazon decide they need to invest a lot of money to build their infrastructure, right? And you've heard the stats that they've built more distribution space in the last 24 months than they had in the prior 20 years. Our back of the envelope number, capitalizing some of the intangible investments that they made, is that they invested in 2021 north of $120 billion. So just let that sink in for a moment. This is a big company, but $120 billion. Can you name any other company ever that spent $120 billion on investing in their own operations in 12 months, right? So it's extraordinary. And I think what you're seeing now, particularly on the retail side, is you mentioned, basically no profitability, but this is the old visualize the pig going through the python, right? In other words, you've loaded on expenses, growth has slowed. They're going to eventually grow into it sooner or later, right? But you're now at sort of peak inefficiency, right? And they mentioned $6 billion of, I think, foregone profits, of which 2/3 was in their control and 1/3 was outside their control, supply chain, inflation, and so forth, right? So this, it'll just, if they're good managers, they should be able to manage through this, and you should see precipitous drop in the investment needs, right, for the business as they grow into this infrastructure they've built. Now, for AWS, look, it seems to be a market-leading, company. They're very simplistically, you look at pre-tax return on assets, they're very high. They've been growing very rapidly. They seem to be in a very strong position. The counter argument is, will ultimately Microsoft and Google, both very well-heeled companies, lots of money, lots of resources, will they be able to be more effective competitors? And only time will tell. And will pricing, as you pointed out before, will pricing drive returns down and so forth? So it doesn't so much seem to be the case just yet, but that would be, if there's a concern about it, that would be the concern. Now, if you want to flip to being bullish again, you'd say something like, where are we in the process of evolving toward cloud computing? We're probably early stages of that and so forth. So you could probably create a 3 to 5 to 10 year scenario that's more constructive. So, back and forth on that, but you're exactly right. And, look, I think today these things are trading. What's going on in the market is not so much fundamentally driven anymore, right? There's a lot of emotional stuff that's getting involved today, but I think this is exactly the right way to think about this. And then here's the question: if we reconvene for our book club 5 years from now, right? So we do this call in May of 2027. How do you think Amazon's retail business is going to be? You think they're still going to be, making no money? Or what will have happened if they don't make money, right? So it's an interesting, I'd be willing to bet that they'll figure it out and they'll moderate their spending. They'll generate more cash. They'll look more like a Walmart, which is boring, slow growth, highly cash generative, right? Fabulous business, right? Fabulous, like a big gushing bond, right? Nothing wrong with that, right? So anyway, so we'll see.
We're approaching the end of time here, but you touched on one word, which is emotions. You wrote about the role of skill and luck and intuition. Can you elaborate a little bit your views on that topic?
Yeah, well, and those are, to me, slightly separate topics. And I do want to, before we end, if everybody can indulge me, I do want to talk one thing about, we'll talk about stress for just at the very end, maybe as a parting thought. Yeah, so Daniel, you're right. I mean, it's interesting that I've always been an avid sports fan. Obviously, investing is interesting to me. Business is interesting to me. And so ideas that luck and skill are important. I read Nassim Taleb's book, Fooled by Randomness, which was, I thought, really an eye-opener. I'd read Moneyball, which talked about statistical approaches to things and trying to understand skill versus luck in professional sports. And so I got very taken with this whole idea. And so, as we know, to me, the big idea there is you can think of a continuum of activities, right? On the far left, you might think all luck, no skill, right? So maybe, roulette wheels or lotteries or something. And on the far right, all skill, no luck. So chess matches or running races. And everything gets arrayed. Most things in life are somewhere between those extremes, right? And so understanding where your activity is and then what that means for things like process versus outcome, regression toward the mean, these are all really important ideas. So I just think a greater appreciation for the role of luck and randomness is really important. The very quick point, the most popular concept that came out of that book, it's not my idea, but it's an idea called the paradox. I call it the paradox of skill, which says in activities where both skill and luck contribute to outcomes, which is most things, it could be the case as skill increases, luck becomes more important. So you go, well, how could more skill lead to more luck? And the answer is skill has two dimensions. One is absolute skill. And I think if we look around the world, I think we all agree, absolute skill has never been higher, right? Investors have never been smarter. Businesses have never been better run and better governance and so forth. And we can complain about things, but they're really pretty good. And certainly athletes, certainly those that are measured versus the clock, we know that they've never been better than they are today, right? So we know that. But the second dimension is the key one, which is relative skill. And what's happened in recent generations is the difference between the very best and the average has shrunk. So which is very interesting. So that means that people are uniformly excellent. And when you're uniformly excellent, that means that luck appears to be more important. So Daniel, whether you and I are good tennis players, I'm sure you're a better tennis player than me already, but whether we are good tennis players or not, if we are completely equally matched, so we're clones in terms of our skill, and we play every Saturday morning, the winner will be a coin toss, right? Because we are, whether we're champion players or whether we're the weekend warriors, right? That's going to be the case. So that's the skill and luck. Intuition's another topic. And, it's a fascinating one because people tend to rely too much on their intuition, but I also don't want to say that intuition is not valuable. So intuition can be trained when you have two conditions in place. One is the system that you are dealing with is stable, and the system you're dealing with is linear. So if you have stability and linearity, then you can train your intuition. The canonical example of that is chess, right? You talk to chess masters, they can glance at the board and they will know exactly who's got the advantage. They can glance at the board and they can tell you pretty high probability what is the best move and so on and so forth, right? The reason is they've studied intently. It's an 8x8 board. The pieces move the same every single time. If we waved a magic wand and tomorrow the chessboard was 12x12 and the pieces moved in different ways, right? Those chess masters would be right back to square one because their intuitions would no longer work. So the question is, what are the domains where intuition works and where does it not work? It does work in certain domains. People think it's a lot broader than it actually is. So that's what I would say on intuition. And when executives tell me or investors tell me my intuition tells me to do something, unless it's backed up by a base rate, by the way, it always makes me very nervous because that's usually not the best way to think about that. And can I do my thing on stress? I'll tell you one quick story on this. I think this is an important thing to bring out in today's market environment, and it's very challenging, right? So one of the researchers who I love is a guy named Robert Sapolsky. He's a neurobiologist at Stanford University. He's also a primatologist, so he studies primates. So for the last 40 years, he obviously spends his academic years in the lab, but the better part of those 40 years, he's gone to Kenya to study baboons, and in particular stress in baboons. So baboons operate in troops. And the question is, how does stress move up and down through that troop? So if you're the alpha male or the beta male, who's more stressed out, all that kind of stuff. And if you ask him, why do you study baboons? He'll tell you baboons are physiologically very similar to humans. And like humans, they spend 3 hours a day feeding themselves and the rest of the time tormenting one another. The difference between the baboons and the humans is that baboons, you can shoot a dart into the flank, and while the baboon's sleeping, you can draw blood, measure its cortisol, and so you can measure its stress, right? Hard to do that at companies like WHG day in, day out. Okay. Now, one of the things he talks about is what stresses us out, right? And the notion of the stress response. So one of his most famous books is called Why Zebras Don't Get Ulcers. So you're a zebra hanging out in the savannah, And the question is, what stresses you out? And the answer is a lion decides you're the target for lunch, right? That's not a good thing. Your stress response kicks in if that happens. You pump blood, you pump adrenaline. What's also important is you turn off anything that's a long-term caloric cost. So you turn off immune system, turn off digestion, turn off reproduction, turn off growth, right? And then you run as fast as you can, right? And so you're marshaling all your resources for the here and now. If you elude that lion, you go back to your group and then you return to homeostasis, right? You reverse those processes, you turn off those short-term systems, you turn on your long-term systems, and you go back to what you were doing before. Okay, so that's the animal kingdom. Now the question he poses is what stresses out a human? And, humans have, episodic physical stressors, but in this day and age, most of our stressors are not worrying about where your next meal is going to come from or being eaten by a saber-toothed tiger, right? Most of our stressors are psychological. The American Psychological Association, I suspect this is true everywhere you go in the world, the American Psychological Association every 5 years surveys people as to what stresses them out. And it's exactly what you would guess. It's things like, I'm worried about relationships or money issues or health issues or the big job deadline or whatever it is, right? It's all those things you would guess. The key point he makes is those psychological stressors trigger the same physiological response. So your brain does not distinguish between a physical threat and a psychological threat. And if you're psychologically stressed, you will turn on the stress response and never turn it off. So your body now is thinking that every moment's an emergency and you never return back to homeostasis. So if I ask you, what are the symptoms of people who are chronically stressed? You'd go right through your checklist. You say they have problems with their gut. They have problems with reproduction. They're sick all the time, right? They don't sleep well. These are all things that would flow perfectly from a overexcited stress response. So why is this important what does that have to do with running a company or running a portfolio? The answer is when you're stressed, you shorten your time horizon. And that makes absolute sense if you really are stressed and you're trying to survive in the moment, right? So you're the zebra and you're running away from the line, you're not thinking to yourself, like, where am I going on holiday in 2 weeks, right? You're thinking to yourself, like, how am I going to survive, right? And if you survive, you go back to what you're doing, then so in environments like this, I think people get into that high stress response and they have a very difficult time thinking about, man, if this goes down another X% in the next 2 months, this is going to be bad. I'm going to lose my job. I'm not going to be able to do this, whatever it is, right? So you get very, very stressed. Even though you may see opportunities in front of you that objectively and qualitatively or quantitatively, are going to be very good opportunities for 3 to 5 years. Gustavo, we talked about Amazon. I mean, I don't know what's going to happen, but when you talk about breaking up the businesses and getting retail essentially in quotes for free, do you think that 5 years from now, we're going to be looking at this moment and saying like, gee, they never, that was the end of it. They never made profits in retail, or you think they're going to say to themselves, okay, we spend a lot on infrastructure. We don't need to spend money on infrastructure. We're going to, do whatever it takes to get profits up a little. I mean, just think about that, right? 5 years from now. Okay. And then the other way to think about it is now think about all the times that markets were stressed in the past. I mean, I was a young trainee when the crash of 87 happened. Crash of 87 seemed like the end of the world on Wall Street. I'm just telling you, it was the end of the world. It now seems like not even a blip. I remember, you just go through the whole thing, long-term capital management, go through the Russian, ruble crisis, you go through the financial crisis. All these things were very traumatic at the time and now feel like essentially blips on what is a long-term trend, right? So I just want to emphasize that to people is that we're all feeling the stress and that takes our eyes off the horizon. And, if the degree to which you can keep your eyes on the horizon, that's really, really good. And by the way, same thing, like when things are too good, you should always be worried. When things are too bad, right? You want to keep yourself on that even keel. And that goes back to this point on emotion. And it's very hard to do, right? When everyone around you making a ton of money doing nothing, you feel like you're a chump for being left out of it. You got to stick with it. And then again, when things are really bad, everyone's going to tell you how the world's going to end. So far, the world hasn't ended. And if the world does end, your portfolio is going to be the least of your worries. So
that's true. That's a great tone to finish this amazing conversation, professors. Like really kind of you to cede your time and be here with us. Hope we make the 5 years from now. That'll be amazing. And That's from all of us, from WHG and our clients, everyone watching. Thank you so much for your time, Professor.
Thank you, Gustavo. Thank you, Daniel. Really appreciate your time and thoughtful questions. And have a great day, great evening, everybody. And I hope we do it sooner than 5 years from now.
For sure. That's a good thing. Bye, Professor.
Cheers.
Thank you. Bye.